Good afternoon, everyone, and welcome to another episode of the 5-Minute Talk Show. Now, when we look at investments and the series that we're currently busy with, the next step when we want to invest is to figure out when and why and what you as a client need to understand before you put your signature on any application. Last week, we touched on the importance of effective annual cost and what impact the cost can have on your investment over a time period. So this week we're going to touch on the different type of investment vehicles one need to consider, as well as the market exposure that your investment can actually endure when you have a specific timeline. Now, based on last week's video when I posted it and I saw that no one could actually see what's going on the screen, I've literally taken myself back to the drawing board. Now, the first step when you want to invest, I want you to think about a goal. You have to have a goal. Because when you've got a goal, you can measure yourself against, am I reaching my goal? How far behind am I? How far ahead am I? Do I need to maybe take a little bit more risk within my portfolio through some of the asset classes when I'm maybe falling behind? Or when I'm getting closer to my goal, is it maybe good so that I can go a little bit more conservative? Okay. The next step is the term. It's always important to know in what time frame do I want to achieve my goal, because that's going to depend which investment vehicle is going to suit you the best, as well as how much risk can I take within my investment within the asset classes, so that if there's a lot of market volatility, your time frame that you're in and the goal that you want to achieve can actually withstand a little bit of volatility that happens within the market. And then the last thing that I want you to think about is your budget. Now, I know most financial advisors will sit with you and they'll say to you when you tell them you want to start investing, so what is your budget? And then they work it from your budget, they work it back to what investment vehicle, what time frame. In my opinion, I work it a little bit the other way around. First have a goal, then look at your term, and then you go and establish your budget that can fit into that goal. Now, once you've got your budget, it's as simple as putting it on a timeline. There you've got 1 year, there you've got 3 years, and there you've got 6 years and longer. So if your goal and the term that you want to achieve your goal falls within 12 months, my opinion, conservative. In the later episodes, we're going to touch on the different asset classes and how you can explore them. But for now, your investment needs to be conservative. No market volatility is going to touch it. So predominantly, you're going to be invested into cash, your typical money market and normal savings. If you've got anything between 2 and let's say 6 years, my opinion, you can go moderate. Have a little bit more market exposure, meaning that your investment will have a little bit more equities, a little bit more of property exposure, but you're still going to have your bonds and your cash. That's going to be your safety net to catch your investment in market volatility when it happens. And then anything after 6 years, you can go full on aggressive with your investment. Reason why I'm saying that is the JSE has never ever returned a negative over a rolling 5-year period, and therefore we are comfortable to say that anything in excess of 6 years, you can take market exposure, go aggressive with your money so that you can eventually start outperforming inflation. So let's quickly recap. This is how simple investment is supposed to be. Have a goal, decide in what term you want to achieve your goal, and then look at your budget. Put it on your timeline, conservative, moderate, or aggressive. That's all I wanted to tell you today. Until next time, bye-bye.